Hey everyone, welcome back to the CRE Library Podcast. I'm Dayma Tamanwala, my co-host Garret McGilvery, and today we're joined by Jeff Berger.
Yes,
Berger.
Or Berger.
Jeff is the managing director at TDB Advisory, where he brings deep experience in corporate insolvency, restructuring, and estate trustee services. If you could give the 2-second spiel of what you do, and
Absolutely.
I will tee it up by saying, ideally, you don't have to meet Jeff. He's a lovely guy, but when things go wrong, he is in the room. So to help.
Yeah, well, it's funny you say that. We have clients, and that's their line. They say, love working with you. It's always a pleasure. I hope to never see you again. Right? So I don't take it personally.
Yeah.
So as you said, our firm is TDB Restructuring. We're a boutique restructuring and insolvency firm. We spun out of a larger accounting practice as of February of 2024 and just kind of rebranded our existing group. But, as a group, we kind of have been together for about 10 to 12 years already. We're a full service restructuring firm. We do work across industries. It just so happens to be that obviously there's a lot of real estate insolvency work these days. And we've seen our fair share, which brings us together today.
Awesome. Why don't you just, give us just a brief overview of what the insolvency process looks like for Canada?
I think just so people know how important this is, right before that, could you please set the stage? When we talk about, it's topical that we're talking with you right now, this is like headline news, right? The condo, guys are being sued, people won't close. We were just talking before we started recording that, several of, even people who seem liquid, you'll look at their taxes, you look at their utility bills, and they're not paid on properties that we look at. Right. Yep. So can you just paint a little bit of a picture of what is happening in the market right now? Maybe the high level view.
For sure. I mean, as you said, it's kind of front and center in a lot of newspapers and elsewhere. Look, bottom line is for a long time, you guys, we all seem kind of roughly the same vintage. I think since we've started in the workforce, it's been pretty easy, smooth sailing, right? Money was cheap, interest rates were low, money was free flowing, and, it was good times all around. Over the last couple of years, I think probably since COVID, circumstances have changed. The market dynamics have kind of flipped upside down. Interest rates have gone up. Lenders are much kind of tighter with their loans and underwriting processes, and deals just aren't happening at the same frequency and I'll call it success rates as they were previously. So what we're seeing now is a market where there's just a lot of pain all around, and not specific to real estate. We're seeing in retail and manufacturing, distribution. Really, it's just all across the board, right? Even one that caught my attention. There's an industry publication that just focuses every week. They have a newsletter that shares some of the more recent filings. One that I saw was a duty-free shop at the border to Buffalo, right? I mean, how does that go into receivership? But
man,
there's pain across the board right now, and it's not a laughing matter. But there are a lot of people in different industries that are having some challenges, right? And that's where we come in to help.
And not to make light of it, but we can also call those opportunities.
They absolutely can be. Yeah.
For the right person.
Yeah,
for sure.
Exactly. And sorry to cut in on your question. So
no worries.
Please.
I was just going to say, if you could just give a brief breakdown of what the insolvency process is.
Yeah.
From, you have a good looking real estate project, something probably obviously happens, and then where do you take it from there?
Under the most relevant legislation here is the Bankruptcy and Insolvency Act, obviously, and under that umbrella, there are a number of different processes that can be considered when there is financial distress. I'll just boil it down in simplest terms to either creditor-driven proceedings or debtor-driven proceedings, and what that means is basically who's in control once a process is started. So, a creditor-driven proceeding that we'll be talking, I'm sure, a lot about today is going to mostly be a receivership. Debtor-driven processes would be either a proposal or a CCAA filing where the company or debtor still stays in control of the process, but they have the ability to kind of restructure their debt and with a view to having a profitable or viable business on the other end of it. And, in the context of real estate, which we're focusing on today, there's always some discussion as to what's the best process. And I think a lot of it boils down to trust between the lenders and the borrowers, right? In some cases, if you have a borrower who is putting, in good faith his best efforts forward and has open communication with the lender in most cases, again, doesn't have any joy in enforcing and taking control of a project. They'll do their best. And we've seen a lot of this over the last few years where, they'll enter into forbearance agreements and, really bend over backwards to try and help the borrower right-size the ship. The other flip side of that coin is if you have a borrower who just refuses to return calls and provide information that's requested and just cuts off all lines of communication, the lender's probably going to just enforce directly and appoint a receiver and take it out of the hands of that borrower.
So just as I guess a quick summary, there's two different processes. One where the borrower remains in charge, and then there's working with a partnership between them and the lender who's enforcing the action. And one where the lender simply just takes over the project, basically.
Yeah, in simplest terms.
who determines that? The lender's the one that goes in and makes those enforcements or makes that decision, sorry?
Yeah, so, a lender will work with its counsel and just obviously consider its options. There are, I'll call it more formal processes. The receivership option is the nuclear option, right? That's you go to court, you bring a motion to appoint a receiver. We are not acting on behalf of the secured creditor. We're an independent court officer. And, obviously we have a duty to report and consult with the secured lenders and other stakeholders. But ultimately, we're a court officer and we have to report to the court on what we see in the situation and what we think is the best, path to maximize realizations and value for everybody involved, right? Lenders also have the option in some cases of, going through a power of sale, foreclosure, or maybe some other options as well. It's really, very circumstantial. The more, I'll say, complex a site is, if you're dealing with vacant land and there's, no liens, no other mess around there, no property tax issues and tax sales, anything like that, maybe a power of sale makes sense. When you start getting...
Hold on. Can you, what is the difference? I think
between those, fair question.
I think those terms are used interchangeably a lot. Receivership, power of sale. There's another one that I'm forgetting.
Foreclosure.
Yeah. What's happening there?
So
and I would challenge you also, just because our audience loves stories, right? And you have a lot of experience, so you don't have to name a specific client unless you want to. But like, you tell us like, okay, in this example, here's exactly what happened. Because I think it's a lot easier for people to figure out. You're going to have some listener going, holy shit, I just forgot to pay my lender. Maybe I should get on that, right?
As a general rule of thumb, yes.
yeah, generally, yes.
Yeah. Wherever possible. So look, we don't get involved in the power of sale and foreclosure processes. I can speak to them generally. The biggest distinction is in both cases, the lender or mortgagee is going to have a direct, tie and possession. Well, not necessarily, but in any event, they are going to be in control of the process as opposed to an independent court officer, right?
Got it.
And again, if it's a simple process, again, I'll just reference vacant land with no other encumbrances. There's very little, or at least as little as possible in terms of exposure. For, let's say, a power of sale where a mortgagee can just simply run a sale process. They get paid out, hopefully, and any excess would go back to whoever's second in line, third in line, et cetera. Foreclosure, they're actually taking direct possession and control of the property. I'm not a lawyer, but I believe there's a title transfer. I could be wrong on that point. But also, in any event, it's still the mortgagee in possession there. So the benefit of having someone like us come in as a receiver from a lender's perspective is you're putting a court officer, independent third party in there. There's a lot of, there's something called the model receivership order, which is used in all these proceedings across Ontario. And I think every province has a slightly different version. But it affords a lot of protections with respect to improvident sale of a property. So, if somebody disagrees, what that means is if somebody disagrees with the sale price you get, there's no recourse. It's all dealt with through the court process. And once the court issues an approval investing order for a property, nobody can come back 6 months, a year later and sue you for selling below market value, right? In a foreclosure or power of sale, that option may be on the table still.
And how is that option determined? Is that in your loan terms, or is it just that, often maybe the bigger guys choose to, they don't want any legal liability, so any risk. So they go, let's go receivership.
That's part of it. Absolutely. I mean, every lender will have a different approach to this. Some lenders will say, we're happy to take that risk and have that exposure and deal with whatever may come. Others want zero exposure and it's worth it to them. I mean, look, as I said, the court officer is expensive, right, relative to the other enforcement options. It provides a lot of benefits, but it is a costly process. And you really have, the lenders have to consider with their counsel what makes sense in the circumstance, right? There's no one size fits all. And it is quite circumstantial as to what the best path is.
Gotcha. One term that at least I hear all the time, loan to own. There's loan to own lenders.
All right.
Where do they fall into it? Like, what action do they take? Do they do foreclosure? What they're going with?
Hold on. Just set the back, because maybe the audience doesn't know loan to own. You and I hear this all the time.
So yeah, a loan to own lender would sometimes be called more of a predatory lender, where they're lending on projects where their intention is not necessarily just to be the capital backing for it. They're there to take that project should you fail. And they're anticipating or hoping that you do fail in that process by, giving you that 65% loan. It might be relatively high leverage. It has a lot of, stingy conditions that are part of it. And then they're effectively trying to take that property at 65% of the value of it.
Right. And then, and all the while, if a mortgagee gets into hot water, there's like an ungodly amount of fees, all these things, all these terms that this person who signed the loan document, they were stressed out perhaps when they signed it. That's why they went to this loan to own predatory lender. And now it goes, oh, actually, you didn't see on page 200. No. There's you're paying us the interest continues to increase, but we can operate and so on. So anyway, so back to your question, is it foreclosure, that path? Is it power of sale? I would imagine receivership is a little bit more difficult to implement that strategy.
So it's...
And we're not here to judge.
No, of course. I'm trying to think of the
I may have worked at a loan to own lender at one point. So
look, there's a lot to unpack there. I think in my maybe naive view, I would hope that there are not, lenders who are out there specifically with that MO. But bottom line is...
Well, it's not on their website.
It's not on their website, but then they have a whole development team, management
but
team. But
there are certainly lenders where you see their name and you go, oh, shit, they're involved.
Yeah.
But sorry.
Fair enough. I think, again, it boils down to their risk tolerance, right? Like, there are different options in those scenarios. I mean, if the borrower defaults, right? These are, again, mostly sophisticated parties, and everybody is afforded the opportunity to review these agreements with counsel, in theory at least. Whether or not someone just signs away and waives that right, that's on them. But, the lenders have certain rights. Every mortgage agreement, as you're probably well aware, is going to have somewhat different enforcement clauses and options for the lenders. And some are more aggressive than others, right? I would just say it's really, in my mind, boils down to their risk tolerance. And if they are trying to just, I'll call it steal out the property for, a fraction of what the fair market value is, there's exposure if they go through and just sell it through a power of sale, right? Whether or not that's part of their business plan and want to accept that risk, I can't comment on that. But
I suppose it's light work for a bank to fight a guy who is going through a power of sale.
Yeah.
You know what I mean? I think, he can come and try and, but
you'd be surprised though, right? There's some highly litigious guys who are going to fight it to the very end. And I've seen them.
Yeah. Okay. So can you walk us through, so the process start to finish? So you got a property, as Garret described, maybe it's land, maybe it's often land. but not always, right? Maybe it's a business, maybe it's a multifamily building, although that's the most stable asset class. And so somebody is having trouble paying. There's some negotiations with their lender for a time. Maybe communication starts to falter, and the lender goes, "You know what? We got to take over here. We can't. We have no options. We got to get involved." So what happens then? Like, and from everybody's perspective, like the lender files something to the court, it becomes their Sorry, you go ahead.
Yeah, sure. So, I mean, I'll focus on the receivership because that's my area of practice. So basically, once a lender hits that point, they'll work with their counsel. They'll issue it's called a NITES, Notice of Intention to Enforce Security. That point, it triggers a 10-day period. So the borrower has 10 days to produce a bag of cash. I'll call it. That's the term I like. If they show up and pay out the lender in full in that 10 days. That's great. Everybody walks away happy.
Is this a scenario where a purchaser is getting served? You know where people get served?
Sorry, a purchaser or a borrower?
A borrower, sorry. And they go, hey, Jeff, can I cut in line at the TD? And you go, hey, yeah, my name is Jeff. And they go, boom, you owe me 20 mil.
I don't know the mechanism. I know they have to get personal service. So it's very probable.
So that's why, because I've heard of this where people are literally hiding. They're like, you can't find, and it's tough because the lender will look into it and they're like, God damn, he doesn't know his house. So I can't find this guy.
His car.
Okay. So they have 10 days after being served.
Right.
To produce.
Exactly. And after that 10th day, the lender is kind of free to bring an application to the courts to appoint a receiver or appoint a private receiver. And the difference being, so there's a private receivership. So most mortgage agreements will allow or provide for a mortgagee to appoint a receiver. And I'll just say it's kind of up to them what process they want to pursue. So we can take an appointment as a private receiver, but you don't get all of the benefits of that court order, right? So in terms of protection against improvident sale and environmental liabilities and other risks, there's a lot more exposure for us to take something on as a private receiver. It's a lot cleaner for a number of reasons to go the court appointed route. However, cost is always a factor there. Assuming they want to proceed with a court appointment, they have to bring an application, on notice to all stakeholders. The court will then set a date. They'll hear the application to appoint us or a receiver and make a determination. And if they sign that order, then immediately upon, that order being issued, we take possession and control of the property and deal with the issues that may be, right? So if it's vacant land, that's one thing. If it's a tenanted, multifamily property, that's another set of issues. We've been in situations where it's half-built structures, basically just foundations and some wood framing with no water on the property. So the fire department issues all kinds of crazy notices, and we have to act quickly to deal with those. But it's a whole range of issues that we encounter.
So assuming it's a like IPP and investment property, there's tenants there. Somebody's being paid, bills have to be paid. So when you take over, are you issuing then a notice to the tenants? Hey, we've taken control. Do you then have to pay the bills as well? Or
Absolutely. Yeah. What we do is we get a court ordered charge against the property, which allows us to borrow funds to pay or maintain the property and pay the ongoing expenses. Right. So we build that into the order as we, during the application process, and make sure that we have sufficient funds to maintain the property, pay insurance, pay utilities, deal with any ongoing issues, whatever is required.
Okay. So you get the court order, you're paying, and typically so you're not exactly representing the lender, you're representing all stakeholders to get the maximum price. So at this stage, are you running the process, or more often are you doing a broker selection process, or how does that work?
Great question. So in terms of the sale, we have the ability to sell it as, I'll say see fit, subject, obviously, the court's oversight. So we have sold a lot of properties through, I'll call it a private sale. I mean, we've been in this business a long time. We know a lot of the, players, whether it's the brokers, developers, investors, and we have our own Rolodex, I'll call it. So we have gone through private sale processes quite successfully in some cases. But I will note that most of those were several years back, right? Before the market dynamics shifted the way they have.
Right.
I'm quite hesitant to do that in this market for obvious reasons. So generally now what we'll do is we'll just go to the brokerage community, obtain proposals, evaluate those in consultation with maybe the secured lender, and retain a broker to list it.
Right. And so the challenge, what you're saying is a few years ago, you could go private because you're less concerned about satisfying the lender and maybe the equity. Like maybe somebody just screwed up, but you're pretty much going to be made whole.
So one example, we had a property at Avenue Road and Lawrence, call it.
Yeah. Great
neighborhood. It was a great site. And we knew, we had some preliminary discussions with some contacts of ours who said, the values in this site, especially relative to the mortgage debt, you shouldn't have an issue. And that was, years back when you could bring anything to market and you'd have multiple offers and competing, offers. And it was just a much different time. So we brought it to market privately, ended up selling for $20 million in excess of the mortgage debt. And it was just a great success story, right? On the flip side, we did that same kind of process, I'll say maybe 3 years ago now, right when the market was really kind of starting to experience the turmoil it's in now. And we had, I think, maybe one bid in that first process that we had commenced. I'll call it 20 cents on the dollar of the first mortgage debt, right? So we couldn't work with that, obviously. We then subsequently listed the property twice with two separate commercial brokers, and they had no results. So that's an interesting story. It's the first time in my career, at least, and one of my partners has been in this business a lot longer than I have. It's the first for him as well. We listed the property 3 separate times in 3 different manners. No bid was obtained that was remotely acceptable. And we actually returned to court at the lender's request to just ask for our discharge because they said, look, we're going to give it back to the borrower in this case. He's come to us with a proposal and he'll fund an interest reserve. We just got to stop this because this property clearly isn't moving in this market, right? That's the most extreme example I think I've seen where, we just can't move a property.
How is that decision-making process? Because I've been a part of some of these and it's kind of interesting because I'm often getting calls from a lender saying, who is seemingly in control. It seems like they have much more influence on, if we get an offer, they're like, we'd be open to it.
Yeah.
And it's a tough thing to balance, I guess, the certainty of getting theirs taken out, but then there's the equity on top of that, where maybe if you ran the process a little bit differently, more risk, but maybe they would be less secure. Like, how do you kind of balance those stakeholders?
Yeah.
And then also, can you walk us through the scenario where, sorry, long question, I know, but I don't sell that much land. I'm in existing multifamily sales. But receiverships used to be the cream of the crop, right? Like you were psyched if you got a receivership because you're getting paid at the end. And now,
fair enough.
Oftentimes guys will list opportunities and it's either the lender or the receiver going, okay, we got 5 offers, but we're not happy. So let's just,
you're spot on. Right. And we've had a lot of those discussions. We work closely with a lot of different brokers, I'm sure a lot of them, but we've had pushback, and in some cases we'll reach out with an RFP and they'll just flat decline to submit because it's a very difficult market. And the reality is the sites that we're getting are not the cream of the crop, right? We're getting sites with a lot of hair on them, right? That have all kinds of encumbrances and just different issues to deal with, whether it's planning issues or tax issues or
contamination.
Exactly. So we've had a number of brokers who just have kind of been a little frustrated, have gone through these processes, run a great sale process, and just not yielded any results that are satisfactory, right? And it's not to say anything about them; they did their job, right? But the offers coming in, I mean, look, there are developers and investors who have the capital to deploy right now. There's no question about that. But they're not stupid, right? They're looking for deals. They understand what the market conditions are. And in some of these cases where funds were advanced on a mortgage, 5 to 10 years ago, the value simply isn't there, right? And for a lot of lenders, they're not willing to take that kind of loss. And they're having to get creative. But a third-party offer in a standard or conventional sale process isn't going to cut it anymore.
Like when you say they're willing to get creative, like basically they don't see the result. I feel like there's so much of that going on. It's almost like like every day you get the feeling that there's blood in the streets. Just like a couple of years ago, you're like, it feels like there's inflation, and they're like, no, that's a lie. And then it comes up that it's like the most inflation we've ever had, right? And so, like the way I kind of
what comes to mind there is 2 weeks to flatten the curve, right?
Yeah. And so, like, it seems like there's a lot of this going on with development in particular, where it's kind of like you're just not seeing it, and like, you're not seeing it on as headline news. It's all being done discreetly. So like at what point can you not kick the can down the road? If you're not getting that sale and all of these lenders have, these monstrous losses on their books that haven't been realized, like, are we going to hit a point? Are things going to get resolved? What's the program?
Let's just rewind maybe a bit. And I think it ties into one of the last questions you asked as well. But the process, once we run a sale process, what we need to do as a court officer is report to the court on the results of that process, right? And those results can say we obtained, certain bids, and we're recommending as the receiver here that this bid be accepted, or it can say we ran this process and there are no results, right? And in some cases maybe ask for advice and direction, but that's not really where we like to go. So we have a discussion with the lender at that point and say, what are your thoughts on what we do here? And sometimes they'll say, I think maybe we can add value to the site, maybe revisit the density or other planning considerations. Maybe we just sit back, wait 6 months, and we'll accept the interest accrual for that period and then remarket it, hoping that the market's turned at that point. And then some lenders are just going to say, look, we'll buy the site out and we'll take it on, and either they'll sit on it, they'll find a JV partner to build it out, and have some form of participation so that they can get paid on the back end and recover their loan. But that's not our decision to make, right? What we do then is go to court, and what the court's always going to look at for the sale of any of these properties, and this is where you deal with the improvident sale issue. There was a case, it was Royal Bank v. Sound Air, which I think, don't quote me on it, but early 90s, which set out the criteria that the court's going to look at in evaluating the fairness of a process and the integrity of a sale process. So I'm not sure what exactly led to this before. I guess there were some shady dealings to an extent, but what they look at now is they want to see how long was the property exposed for, how broad of a net did you, the receiver, cast on the market to make sure that you canvassed all of the probable buyers of the site. Was it conducted in a fair and transparent manner? Those types of issues, so that nobody can come back and say, yeah, the receiver went to his buddy. Jeff has a developer friend. He went to him and said, yeah, I got this great property, $50 million of debt, but you give me $2 million and you're good, right?
Yeah.
So none of that can happen in this type of court process. Not suggesting it would, just for clarity, but so at that point, if we are to recommend a sale, including a credit bid by the secured lender, we'll have to go and demonstrate to the court that we did everything we possibly could in the circumstances to obtain the best value for the property, right? And in some of these cases where we're getting offers at 20, 30 cents on the dollar, the lender does have a right to say, look, I've put in, let's take a property where the first mortgage debt is $10 million. They've already advanced the $10 million. Somebody in the market's offering $2 to $3 million. The lender will, if they have the appetite for this type of thing, say, okay, we'll credit bid it, meaning we'll put in up to $10 million of the funds that we've already advanced in the form of a bid, and we'll take the site back.
Yeah.
Right? And, the optics on that can be challenging in some scenarios, right? The loan to own type of terminology you're using. But in some other cases, it's just the best play, right? And you can't fault them, right? In a lot of the cases we're seeing now.
I was just going to say, who makes the ultimate decision in terms of you brought these 3 bids and then the lender obviously is there as well, but who makes that final call to actually complete that process?
So we as the court officer will make a recommendation. So we'll enter into an APS subject to court approval, right? The court puts a lot of faith in their court officers and the decisions that are made. We still have to obviously demonstrate to the court exactly what logic we use to come to our conclusion. So to answer your question, we make a recommendation, we being the licensed trustees or receivers, to the court, but ultimately it's the court who approves the transaction.
Interesting. Can you speak to the, like I talked a little bit about kind of the shadow stuff that goes on in the background. There's pain, but it's not at the surface. And we've talked about this on the podcast before, but like a lot of developers, for instance, have a restriction for when they do pre-sales. It's like, you can't go out and sell this. You can't list it publicly. And so there's entire markets or like Facebook groups that are like GTA assignment.
Yeah.
Right. And so I find it's like the only thing that I look at on Facebook. And it will be like, you know, I bought this great condo, 1,200 square feet for, you know, $4 million. And, you know, I'm willing to lose my deposit plus $200,000. And then the comments, all the reactions are like laughing emoji. And then the comments are like, you stupid idiot. You think somebody's I wouldn't buy it for half that. Like, come to me. And so that's like, it's like 50 comments like this. So can you speak a little bit to what's happening on the development side? What happens when, you know, somebody does that, whatever, 70% pre-sales, and then they still have the remainder? Like, what are you seeing out there? Like we're hearing about a lot of people being sued to close and, you know, challenges at the back end. What are you seeing? Take us out of the shadows.
Yeah. So, I mean, look, we don't deal with that kind of assignment market on Facebook directly, right? But
no, nobody does.
I think, fair enough.
It's just me, people like me watching it and going, shit, I'm glad I sold my condo.
There may be opportunities, as you said.
Yeah.
You know, I think I'll put my own spin on it, because I think there's an important point here, which is, you know, the purchasers who are subject to these deals when, you know, the developer who they've contracted with goes into a proceeding like a receivership. And it can be a difficult situation. So when we get into a project where there are existing pre-sales, whether they're direct or assignments, I'm not sure that it really makes much of a difference from our perspective. But bottom line is, we have to consider what to do with those purchase agreements, right? And in a lot of cases, what you would see, and it's not really our decision, but we have to disclose them in the sale process, and developers or the purchaser ultimately has to decide whether there's value. And, you know, between, you know, 2015 up to 2020, 2021, in a lot of cases, the market was just growing exponentially every year. So a pre-sale from 2016, if you're going to sell a property in 2019, represented significantly lower value. And in a lot of cases, a purchaser would ask us through the court process to basically terminate those pre-sale agreements so they could go back to market and sell at the new high water mark, right? Now that has changed somewhat. And, you know, if there's an agreement from 2018, 2019, and the project still hasn't been completed, and those are still valid and binding agreements, you know, it's likely that a purchaser would want to assume those. The problem for the purchasers is what happens, you know, in that former scenario where the court will actually terminate their agreements. What happens to the, you know, their rights, their deposits? And unfortunately, it's not a pretty picture, right? You know, Tarion has insurance coverage for deposits on, you know, condos and freeholds somewhat differently. You know, condos, and I've asked a lot of lawyers about this, and I still don't have the best response. Condos, a developer can't touch the deposit funds unless they have supplementary deposit insurance, right? So in other words, if you're a purchaser, you put $100,000 down, you're more or less guaranteed to get that back if the condo goes into receivership. If it's a freehold development, there is no such restriction, right? If you put, in some cases, we've seen $200,000-$300,000 deposits on a home, only a portion of that is actually covered. So I believe the number is 10% up to $100,000, right? So if it's $1.5 million, you'll get maybe $100,000, but you're left holding the bag for the residual $200K. And we've had a number of discussions with these purchasers. I mean, in some cases, it's terrible. I mean, they'll say we put $300,000 as a deposit. The developer has spent all this money, obviously. You know, that's why they're not servicing the debt, and there's nothing to be found by the time we get there. So they say, what are my options? How do I get my 300 back? And the answer is, unfortunately, you can file a claim with Tarion once your agreement is formally terminated, but they'll only cover a portion, and there is no other recourse for you. So, you know, as a PSA here to anyone listening, if you're in the market and putting a deposit on a pre-construction home, make sure you read the fine print and understand what you're in for in terms of your deposits.
Are you seeing a lot of low-rise developments in receivership? Obviously, you're talking about a very specific topic at that point, or a good example, but are you seeing a lot of that?
I think we're seeing across the board. When you say low-rise developments, I mean, we get a lot of vacant
freehold
land these days, right?
Yeah.
And, zoning across the spectrum. So yeah, in that sense, I mean, look, vacant land is non-income producing. That's going to be the first thing to go in any market, right? Because it doesn't generate any cash to actually fund the debt obligations. We have had a couple, we did one, I'm sure you guys saw in the news at some point, the Stateview receivership. So we had one of their projects in Barrie. It was, I don't recall, roughly 20, single detached homes there. That was one of the sites where we got there and it was just partially framed and a whole, nightmare scenario in that sense. But, we're seeing some of that. I wouldn't say it's the majority, but yeah, it's across the spectrum really.
Versus last year or 2 years ago, like what sort of rise have you seen in these opportunities, the scale of it? Could you frame a number for us?
Opportunities.
Look,
yeah.
It's hard to pinpoint. It's a dramatically higher number in the last 2 years than we've seen in the decade prior, right? We used to maybe get a couple calls a month, if that. Now I think we're getting multiple calls a week, if not daily. I mean, there's a lot going on, and there's no sign that it's letting up, right?
Do you have a challenge when you're like having beers with your buddies and they're like, yeah, fuck, this market is terrible and whatever, and you're like, and the guy's like, I'm gonna have to sell my house. My kids won't have a pool anymore, and you're like, oh no,
there's new Rolex on the arm. You're like,
buying it. Yeah.
Thankfully, I don't have friends who are in that situation, but obviously there are people in this economy who are struggling to make ends meet. And look, I don't take any joy in the situation, right? We provide a service that I like to think we're helping to facilitate this process, and we're an independent party that genuinely has a duty and obligation to make sure that nothing untoward is happening, right?
Yeah.
But
I should note, I don't mean to make too light of it.
No, it's a fair question.
The show's supposed to be entertaining, so
Hey.
Obviously it sucks. And for those PSA, if you're going through it, good luck. There's an end to the tunnel. So let me put a positive spin on it. This is going to make me sound like a scumbag, but where are the biggest opportunities if you have to put on your investor hat? Based on everything that we're talking about or what you're seeing out in the market, like if somebody wants to make a lot of money, what are they doing?
If I knew that, I wouldn't maybe be here.
Okay.
I don't know that there's a specific formula, right? I think at the end of the day, there are opportunities, no question about it. I think it relates to the lender's, threshold and willingness to take a loss.
Let me ask it a different way.
Mm-hmm.
On the recent deals that you've done, was there one where you're like, it made sense for everybody who was on the sell side and trying to get made whole? But was there ever one where you're like, God damn, I would do that deal. That's a really smart way to structure it from whoever bought out the site.
It's a great quote. We've seen a lot of aggressive and creative offers, but I'm trying to think of one that's actually gone through and passed the smell test and gotten court approval. I'm not sure. Like, we've seen a lot of Hail Mary offers out there, right? People are, as I said, they're sophisticated buyers out there with capital to deploy. But it has to pass through court approval. And if somebody's going to come in and make I'll call it lowball or extremely aggressive offer, power to them. And in some cases, yeah, you may be successful, right? Again, it depends on the circumstance. But I haven't seen anything trading or transacting really at that mark yet.
So I guess that's just more so an indication that lenders aren't in that significant of trouble and they're able to still hold it on their books, even though it's obviously in receivership at this point, but they're not desperate. Where you've seen it a few times in the United States where they'll sell their whole loan book for like 50 cents on the dollar or something because some credit union is just completely underwater at that point and there's no fire sale effectively.
Right.
Yeah.
I feel like also to your point earlier in the pod, like a little bit of financial engineering when a lender's like, all right, it looks like we lost $50 million here, but wait, our value add fund just bought it and we just got it appraised at 100 mil.
Yeah.
You know what I mean? Like, I feel like all of a sudden we're fine.
Yeah.
Right. So, it's interesting to see what's
that's his ballpark more so, right?
Yeah. Well, hey, there are a lot of lenders that also happen to do development.
Yeah,
also happen to
absolutely.
have property management arms.
Absolutely.
So it's like, it all kind of works together there.
Yeah.
What is your prediction for, the next 12 months?
Again, I don't have a crystal ball, but based on what we're hearing, I don't think it's letting up anytime soon. If interest rates drop, it's going to be, I think, a nominal or fairly small, maybe another 25 points, 50 points over the next 6 to 12 months, from what I've seen. I don't know that's enough to move the needle and really change the market fundamentals here. Right? There's a lot of, I'm sure a lot of your other guests have said the same thing. It's uncertainty and speculation and just a level of fear in the market, right? That needs to be addressed before people are going to jump back in.
And now I will just add another side to this so that everybody doesn't drive into an embankment. What you are often seeing is land, and so more often than not, unoccupied land, spec land, and that sort of thing, or like that.
There's a lot of that certainly, but it's
yeah, and people broadly, some companies are experiencing trouble, but I would say from my perspective on the multifamily side, a lot of people are well capitalized.
Yeah.
I've been shocked at the amount of liquidity, especially post-election.
Yeah.
And so, not for every asset class. Maybe office is still a little challenged, very challenged. Industrial has some tariff issues, but is broadly doing okay.
Yeah.
Multifamily is doing fine in most ways. And so, it's not all bad.
Absolutely not.
Yeah.
Right? It's funny you say office is struggling because we don't see a lot of that, at least to this point in the insolvency space.
Right.
So yeah, you hear anecdotally there's a lot of pain in that market, but I guess a lot of the office space, particularly I guess downtown and more densely populated areas are owned by institutional investors and they can weather the storm a bit. But yeah, look, as you said, it's not all doom and gloom, right? Like there's still there's capital out there, there's good opportunities, and there's sophisticated parties on both sides of the table, right? So deals can get done, and it's just it's all relative to what has been and what is now, right? I don't think that 50% of the loans out there are in default, and that would be a very different situation. It's just relative to what the market norm has been in the last couple decades. It's we've seen a huge increase in activity.
Speaking of crystal ball,
Yeah.
Do you have any? So we saw like Hudson's Bay Company, Saks Fifth, our friend of the pod, Sam Mizrahi's project had a little trouble, to put it mildly. Are there any, maybe not naming by name, but naming by vertical or by industry? Like, is there anything that you have your eye on where you're like, this is heading in a tricky direction, so we should watch out for this?
As I said at the outset, we're seeing different industries have some pain points, and I don't know that I would attribute it to one specific area. Retail, I think, has had its challenges for years, and we're going to continue to see some struggles there. Things that are impacted or businesses impacted by the tariffs and the uncertainty caused there. So freight, logistics, there's been, since COVID, the freight trucking industry, you've seen a lot of insolvency files come out of there. And with the tariffs and everything happening now, I don't think that's going to let up either.
Yeah.
Logistics, it stands to reason, right? But I don't see any particular sector imploding. But I just think there's...
And it's worth mentioning the nuance of like, one of the buzzy terms, flight to quality. There is still a huge difference between struggling office and, AAA office or, maybe small bay industrial. I don't know industrial well, but like maybe that versus the big box versus, it's all, you can't paint it with a broad brush. It stands to reason,
right?
Yeah,
like
exactly.
If you're someone who's going to rent, 30,000 square feet in a AAA tower downtown, you're probably not all that sensitive to price and all that, right? If you're someone looking to rent 1,000 feet in a C building, it's a different proposition, right? So anecdotally, yeah, we've heard a lot of people since COVID have taken less space in better towers. I mean, we're in the office searching for a lease ourselves, and that's my exposure to it. I haven't, as I said, dealt with a lot of or any insolvency in that space, but that's what we're seeing. I mean, yeah, the great high quality space is low vacancy right now. Whereas the B and C buildings are starting to have, maybe not trouble, but certainly more vacancy.
We have all sort of, we got owners listening, we got a lot of brokers listening, new people to the industry, old veterans in the industry. Is there anything that they should be paying attention to if they want to work with you? What's the process? When do you get the call? Who's calling you?
Yeah, great question. We're always happy to speak with anyone who thinks that we may be able to assist. I mean, a lot of our calls come from, lenders, lawyers in the insolvency community and litigation community, developers. I mean, really from everywhere. But yeah, certainly if anyone has a question or just wants to bounce an idea, by all means. Yeah.
Hopefully not. But if they need to, then you're there.
That's what we're here for, right? As I said, it's a service and you hope not to need it, but we're here in any event.
Yeah.
Do you have any other questions? There's a lot on this that we didn't cover, but I'm cognizant of.
Well, I'll just add this, guys. Like, I'm coming at this obviously from one perspective, right? I see doom and gloom. That's my day to day.
Yeah.
You guys have a lot of, extremely talented, qualified, I'll call it heavy hitters on this from across the spectrum who are obviously extremely knowledgeable, much more so than I am about the real estate industry in general. But I'm just here to provide my perspective, and hopefully it's been informative.
Yeah, I think after this podcast, we should really get on another like a Brad Lamb type. We need a market bull.
Yeah,
we need because there are people with that attitude, and
I may have one for you after. We'll talk offline.
Okay, and let me ask you this: so Warren Buffett would say it would be greedy when others are fearful, and the opposite. Whatever, butcher the quote. Should we start getting greedy? If you're telling me it's going up. Everybody thinks insolvencies are, on the rise, or they are, as a matter of fact. But should we start? Is now the time? Is that what you're saying?
I think.
Pull the trigger.
Yeah. Yeah. Go all in. Why not?
Yeah. Doesn't the
there you go. Podcast over.
Doesn't the contrarian make the most money? And I will say this, as they say, the pessimist is usually right. The optimist is usually rich, unless they happen to meet you.
There's a lot of nice catchphrases and buzzwords out there, but look, everyone's got to assess their own appetite for risk here. Certainly, there's opportunities, and for those bold enough to take those risks head on, absolutely, I think there's money to be made. Right, no question about it.
Love it. You heard it here first, Jeff. Thank you so much for joining us on the pod.
Thank
Pleasure.
you, Jeff.
Thank you guys so much.
Appreciate it.